Well, good evening, students. Good evening, students. I'm welcoming you all in our class, TAX2601, the module which is Introduction to Business Taxation. Introduction to Business Taxation. Yes, it's a semester module. I'm sure around May or June we'll be writing the examinations. And along the way, there are a number of quizzes, there are a number of assignments which we must do well in. As our second class, last week, we more like it was our first class with some sort of just simply discussed. We're just talking about the theory on tax administration, on introduction to taxes. So for us to understand better, the best way to understand is the theory is through questions. I have got a number of questions for me. For a person who have been teaching this module for a number of years, I'm sure from 2016, I do a number of questions which we can use to master the tax administration very, very well. So here is the questions which we are going to use. I'm sure this one is the tutorial letter for 2021, but the questions still remain valid. Those who are going to be part of me, don't worry about the textbooks. So those ones who are going to join my class, don't worry about the textbook. I do have the textbook here, even though there are some adjustments here and there. We'll use a lot of material to adjust to the current year. So save your money by coming to my class, and then you don't buy the textbook. You use that money to pay for my classes, for my services, and then you benefit quite a lot. And again, over the years, I've seen people who buy the book and end up having challenges in using it. So before wasting our time, let's go straight to the questions which covers tax administration. I'll write as we go. Question 1. What does the question 1 say? What does question 1 say? I'm seeing some songs just gotten in. I don't know the name. Just saw Samsung. Is he still in? What's your name, Samsung? And welcome to the class.
My name is Ntavise.
Hi, Ntavise, welcome. You feel at home. Feel free to ask some questions as well as we go on. Yes, question 1 says, when interpreting the word used in the Income Tax Act, the application of the contra physicum rule may be necessary. What does this mean? What does the term mean, contra physicum? What does the name contra physicum mean? First of all, we see the word Income Tax Act. And with the text from my previous class, I said tax is a tool used by the government. It's a tool used by the government to raise revenues, to raise money. The government needs money. We must pay for the services. Teachers need to be paid, soldiers, infrastructure is to be provided for. To use that, the government uses taxation as a tool. So for the good administration of tax, the legislatures came up with the Income Tax Act. You know, in Parliament, that's where all the law is generated. So the legislatures came up with the Income Tax Act, which provides law for the administration of tax. So this income tax is the Income Tax Act 58 of 1962. So as you know, with the law is not straightforward. One sentence in the law, remember when they designed that law, they are also preparing to run away. So the law is not straightforward. Then you have got a law which is not straightforward. And that law is going to be used by people to collect revenue. So if the law is not straightforward and the people are and different people are using the same law to collect revenue, guess what might happen? What might happen in Tavi saying if that is the case? If you are all administrating, if you are doing tax administration, and there is in Tavi saying there's another one here, there's a Tsulu, you go out, what would happen if you are using the law which is not straightforward? Just guess what might happen. What might happen in Tabise? Yes, let me help you there. What might happen? It's some contradiction on how you do. Because Tsulu would interpret it in his own understanding. Tabise would interpret it on his own understanding, which would conflict and make work very difficult. So in that case, because of that, this commissioner of SARS, the commissioner of SARS, this administrators under SARS came up with their own interpretation. Came up with what? With some interpretation. I came up with some interpretation to help in the administration. So their everything would be interpreted into interpretation notes. So on the interpretation notes, that's when they will, that's where the word contraphysicum is coming from. On our textbook last week, let me go to our study guide last week. Here on this note, I'm sure you are all seeing here. So when the commissioner of SARS is interpreting the act, the first guideline is using the literal meaning first, meaning words must be used in their simplest form, not more confusing words, because the law itself is confusing. Then guideline number 2 is, yes, if they are interpreting, after when they use simplest words, what they would do as well, they must pay closer attention to what was the intention of the legislators. Remember, I said the parliamentarians, they come up with a law for different purposes. Sometimes it's to promote some sectors, sometimes it's to discourage consumption. So when SARS is interpreting the act, they don't want to go against the intention of legislators, because that might be trouble. So the second guideline, after using the simple words, is to pay closer to the intention of the legislators. Guideline number 3, it's contraphysicum. So the word contraphysicum, it means the contraphysicum rule applies in this way. As you interpret, remember I said in the first part, if Tsulu goes there, if Pintavi saying going there, there is some contradiction, because Tsulu would interpret according to her own understanding, Pintavi saying according to her own understanding. As a result, there will be conflicting clashes, disagreements within SARS organization. So that is the need. So when it comes to contraphysicum here, it's how are you going to interpret, especially a wording, which has got 2 meanings, which are different. How are you going to do it? Yes, you interpret, you use the simpler words, and you go to the intention of the legislator. It's fine, but when you come, you still get more than one interpretation. So if you apply the contraphysicum rule, you look at what would be easier for the taxpayer. Meaning you take closer, you look, you choose an interpretation which favors the taxpayer. Are we together?
Yes.
Where an interpretation produces two or more interpretations. Then an interpretation that places smaller burden to the taxpayer is adopted. So meaning SARS will now get like what would be easier for the taxpayer is what they consider. So at the question, what is the answer here? What would be the answer here? Which option would be the answer?
I think it's number 3.
Yes, point number 3. Thanks so much, Sulu. The answer is point number 3. Yes, an interpretation that places the smaller burden on the taxpayer would be considered. Then let's go to question number 2. What does question number 2 say? Question number 2 is asking us, in South Africa, taxes are taxed on a residential basis. What does this mean? What does this mean? Anyone with an idea? Understandable, because most of you, you are doing this module for the first time. So when in South Africa, if you are a tax practitioner, I know you all want to be tax practitioners in the future, or you will be accountants. So let's say, yes, whether you are an accountant or a tax practitioner, if you have got a client, the first thing you must consider is whether your client is a resident or not. Are we together, Zulu? Look, if
Yes.
your client is a resident or not. So if your client is a resident, your client should be taxed on all over, on income earned from all over the world. So if your client is a resident, you just say, bring me information about all your income, no matter where you have earned your income from. Whether you earned it from Nigeria, Mozambique, China, America. That is if it is a resident. Meaning a resident is taxed on worldwide income. But if a person is a non-resident, yes, that person can be taxed, but you only take into account amounts earned in South Africa. If your client is a non-resident, you are not going to ask them to bring proof of income from Nigeria, from Zimbabwe, from Mozambique, from China. No. You say, yes, you are a non-resident. We only want your income and expenditures, which their source is in South Africa. So that is the residence basis. What did I say? What did I say? Tabi saying, are we together? What did I say? If your client is a resident, what would you do? I said you are going to calculate their tax using income earned from all over the world if they're a resident. If they are a non-resident, their source, the source of income you take into account is the one which has been earned in the Republic. So what is the answer, Tsulu here? Option 1 is saying all South African residents are taxpayers. Is that the meaning? No. People are taxed according to the area in which they reside. Is it? No. You are not going to be taxed because you come from Plupane. No. A non-resident do not pay any tax in South Africa. No, they pay, but they are only going to pay on income they earned in South Africa. So option 3 is wrong. Option 4, residents are taxed on income they earn from anywhere in the world. I'm sure this is the answer, Tsulu. Eh?
Oh, yes. Yes, number 4 it is.
Yes, it's number 4. Residents are going to be taxed on worldwide income. Residence basis means residents will be taxed on worldwide income. Whilst non-residents will be taxed on income earned in the Republic only. That is it. How much? What is our answer?
It's number 4.
Option 4. Thanks so much. Let's go to question number 3. Question number 3. Which interpretation rules are binding on SARS and taxpayers? Which interpretation binds SARS and the taxpayer? Which one? Binding class rulings? Binding general rulings? The opinion of SARS? The interpretation notes? Which one are binding on SARS and the taxpayers? We go back again closer to, was it the first question? Remember I said the law is designed in parliament by parliamentarians. So if that income tax act is then brought to SARS, SARS would try to interpret. Yes, they do have interpretation notes. Interpretation notes are only, it's more like the law which they use. It's their guidelines. Interpretation notes are not actually binding because it's SARS's opinion. Sometimes the opinion is going to be followed, and sometimes the opinion can be challenged in the court of law because it's more like an opinion. That is interpretation notes. There's something within SARS which is binding. These are binding general rulings. Are we together? The binding general rulings are the ones which are binding. Here they come up with the interpretation which is binding. I'm sure you are still new to this module, but as you go, what I like to give is an example on what you are going to encounter when you do your capital allowances. Or let me go to the last page of this study guide or this of your textbook. as you go to this study. Yeah. So this is an example of binding general rulings. This is an example of binding general rulings. When they interpret, I do have the act with me here. Unfortunately, I've closed it. You are not going to see any paragraphs in the law. But however, SARS, when they interpret, the act would say a taxpayer is going to pay tax at a particular rate, at a rate prescribed by the commission. But now, what the commissioner prescribed is now it will be binding to both SARS and the taxpayer. For example, how natural persons are going to be taxed. You are taxed by such a table. It's now binding to all natural persons that you are going to be taxed depending on your taxable income. It's interpretation, yes, but it's binding. It's binding SARS, it's binding the taxpayers. For companies, if you go to the act, they will tell you that companies is going to pay tax at a fixed rate prescribed by the commission. If the commissioner now comes up with something binding, they say it's 28%, but 28% was before 2023. But from 2023, it's now 27%. The tables, the travel allowance tables, this is what it's binding. When you go to capital allowances on assets, on wear and tear, you see. If you can go to section 11E of the Income Tax Act, they will simply say there's wear and tear allowance. But it doesn't specify how wear and tear is determined. But binding general ruling will come and say cellular phones are going to be written off after 2 years. Computer software is going to be written after 2 years. Furniture and fittings after 6 years. You see, it's now binding general ruling. Binding general ruling, it's more binding. It binds all the taxpayer and SARS. But if you look at interpretation notes, they are not, it's just opinions. Binding class, binding class, it's like now when we talk about if something is binding a class, it's like we are a group of, maybe we are retailers, or maybe we are farmers. We go in the act and we don't find where we fit in, or the way we can apply that law, because we've got an exceptional circumstance which was not looked into by legislators or even by those who interpret the act. So we can as well, we can approach SARS, we can make an application to SARS as a class and say, how are we going to treat such a transaction? Then SARS would come up with what we call binding a class. The binding class will only affect us, this class. Like we've got a class, binding class ruling which affect universities when it comes to value-added tax. Because when we go to the Value-Added Tax Act, it says educational services are exempt. So the universities approached the SARS and said, no, but we also we do sell books, we do carry out some activities. It's unfair if you say everything that we do it's exempt for VAT. We would also like to claim input tax. Then SARS came up with a ruling which says universities are going to claim input tax at 11 or 12%. That is a binding class ruling. It's just for universities only. So the one which is proper, especially at this level of yours, even though this one is binds SARS and the particular class, but the one at this level, apply binding general ruling. The interpretation rule that binds SARS and the taxpayers is what? The binding general rulings. I'm sure I showed you how they're applied. They become law. It's an interpretation which has become law. That is the binding general rulings. It binds SARS. It binds the taxpayers. So option 2 is the answer. Anyone with a question? Anyone with a question before we proceed? Anyone with a question before proceeding? Okay, let's proceed to question 4. Which one of the following statements is true for the alternative dispute resolution? Which one of the following statements is true for the what? Alternative dispute resolution. What is the alternate dispute resolution? Okay. Let's do it like this one. Can you all hear me, or is the network is bad? I'm looking at the bars. The bars are very low. Can you hear me clearly? Let's communicate. Can you hear me?
Yes, we can hear you.
Okay, thanks. I'm seeing the bars of my resident router is very low, and sometimes it's up and low. I thought maybe I might be cutting. It's not nice to continue when no one is hearing you. Okay. Yes, let's go to remedies. With the text, you file in your return, and the SARS would assess you according to the information on your return. And they send you the taxable income and the amount of tax you must pay, the date in which you should pay. But sometimes you are not happy with their assessment. You don't agree because you have got your own idea. You have got an idea on how much tax you must pay according to your understanding. What happens when you are not happy with the SARS assessment? So here are the legal remedies. The first part is to request reasons. Are we together? What do? You request reasons from SARS. Okay, how did you come up with this assessment? And SARS would reply you, but you must request reasons within 30 days of receiving a notice of assessment. If you don't request within 30 days or object within 30 days, SARS would say, okay, maybe you are happy. They will deem that the assessment is final. So maybe you make sure you understand the days. So after requesting reasons, and the SARS answers you, because the SARS have got 60 days to give you such. So if SARS give you reasons, you have got how many days? 30 days to lodge an objection. So 30 days for what? But you do it on the notice of objection form if you are registered on e-filing. If you are not registered on e-filing, that's when you use ADR1. Like last week I said, yes, which type of taxes are on e-filing and which ones are not on e-filing. For personal income tax, yes, it's on e-filing. You use the notice of objection form. For corporate income tax, tax for companies or value-added tax, you use the notice of objection form. The following are not available on ADR or on a notice of objection form, of which you use ADR1. For pay as you earn, income tax, for trust and other taxes like donations tax and dividends tax, you use the ADR1 form because they are not done on e-filing. So yes, after you have filed in a notice of objection where you are objecting, so where you are, so if you are, yes, if you are not happy with that, then you object, and then SARS have got 60 days again to either accept your objection or reject your objection. If they reject your objection and you don't agree with them, that's where you would file in a notice of appeal. Under the notice of appeal, you will simply be saying, I'm appealing further, maybe to the High Tax Board, to the tax court, because you are not happy. So the notice of objection again, there's a notice of objection, notice of appeal form on e-filing. Or if you are not registered on e-filing, you use ADR2, especially for those other taxes which are not on e-filing. So before SARS allow you, before SARS agrees, says, okay, you can go to the courts or wherever you can go. Under SARS administration, there's an alternative dispute resolution, which is the topic for the day, the topic of the question, alternative dispute resolution. Under the alternative dispute resolution, it's more like a mediation process where the matter is mediated. The taxpayer who is aggrieved and SARS as well who want their money. There's a mediation process. That's where the alternative dispute resolution is. Matters are talked through so that we can all reach an understanding. We can be on the same page. It's important because it's cost effective. You are not going to spend a lot of money like you need a lawyer or so. You try to reach an understanding because you don't want to go there to the courts. First, you have to really understand each other. This is the alternative dispute resolution. But still, if the mediation doesn't give in something which is understandable to one of the parties, that's where the matter can now go to the tax board. You need to understand the limit of the tax board. The tax board is limited, one, with the amount prescribed by the commission. 500,000 was long ago. I'm still waiting for the new test study guide. What your new test study guides are saying. It might be 1 million right now. If an amount is more than 1 million, this textbook, it was 500,000 rand. You would not use the tax board. Or two, if one between you, the taxpayer, and the commission are not happy, or you don't believe that the tax board can handle such a matter, because the composition of the tax board is only an advocate or attorney only. If necessary, an accountant. If you both agree that, okay, these people are too small for this matter, you can jump the tax board and go straight to the tax court. So there's a tax court in each and every province, but it's only handling tax matters. So if you go to the tax court and the tax court fails to give a satisfying ruling to one of the party, an aggrieved party can take a matter to the High Court. Now you go to the Hague, you now go to the High Court. If the High Court is not going to give something which is more like understandable to any of the party, an aggrieved party would go to the Supreme Court of Appeal. So the Supreme Court of Appeal is more like the last court to which would be handling really the tax matters. The decision by the Supreme Court would be more like final, unless the taxpayer is raising constitutional issues. If one of the parties feel like it's now unconstitutional because you understand the Constitution, that's when an aggrieved party would go to the Constitutional Court. But remember, you can only go to the Court with the constitutional issues. Anything which is not about constitutional, anything which is not about the Constitution will end on the Supreme Court of Appeal. So now let's go to the question. I'm sure now you know the dispute resolution process. What does the question say? They want a true statement concerning the alternative dispute resolution process. If you can look at our map, the alternative dispute resolution process is here. Just before going to the tax board or to the tax court. Let's look at the options. Then the dispute will be resolved. No. When you are mediating, it's not a must that you should follow one. You must be happy. Two, the taxpayer is to accept SARS's interpretation, then the dispute will be resolved. No, that is not it. SARS does not keep a register of disputes settled through this process, as all cases are unique. No. They must be kept. The process may be used to settle any dispute that relates to a dispute or an interpretation of facts. So this one is the true one. It's used for anything. It's used, it's a must. You must use it first before going further. So option 4 is the answer about the dispute. So let's go there and read a little bit about the dispute resolution. Should the taxpayer indicate on the notice of application form that they wish to make use of the alternative dispute resolution, SARS and the taxpayer may use this process to settle any type of dispute that relates to a dispute on interpretation of facts. To settle does not mean that the taxpayer or SARS is to accept one or the other's interpretation. It just means that both parties must agree on the text in question. SARS is to keep all the dispute that it settles by means of this process. That is it, mediation. Let's quickly move on to question 5. Which one of the following statement is true relating to the legal precedent? A legal precedent is that order. Is that order which we said, okay, request reasons, After getting the reasons, you object, and you object. You notice of appeal, alternative dispute resolution, tax board, tax court, high court, Supreme Court of Appeal, and then later on Concord. So which one is the legal precedent? Which one is the right order? That is the question is saying. A decision by the High Court is binding on the Supreme Court of Appeal. Is this true? No. Remember, which comes first? The Supreme Court is higher than the High Court. There's no way the High Court can bind somebody who is bigger. When you bind somebody who is smaller than you. Even those who go to church. You bind a force which is what? You must have powers than that force to be able to bind it. So yes, the High Court cannot bind, but it is the other way around. The Supreme Court is here. If that is, if a higher court fails, then the matter will go to an aggrieved party would go to the Supreme Court. So sometimes somebody who lost in the High Court and the High Court made a decision, the Supreme Court can come up with a ruling which cancels here. So meaning what is decided here at the Supreme Court of Appeal will bind any decision made at the High Court. So the first one is wrong. 2, a decision by the tax court is binding on the High Court. A decision by the tax court is binding on the High Court. Is it true? No. Just let's look at our map again. Where is the tax court? It's here. There's no way the tax court can bind a High Court, because matters go to the High Court when one party is not happy with the ruling of the tax court. So the tax court cannot bind the High Court. Then the decision by the tax court is binding on the Supreme Court of Appeal. No way. No way. No way. No way. The decision by the Supreme Court is binding on the High Court. This one is true. It's binding on the High Court. Option 4. Now we go for the bigger one. Now we go for the bigger one. Question 6. Which one of the following best depicts the taxable income calculation framework? Taxable income calculation framework for a company. Normally, I do have my framework which I use for my students. Let me quickly go to my documents and share the document which I normally use, so that you get a full understanding. Taxable income calculation. Taxable income calculation. Can you see the framework? Let me make sure that you are, or it's visible to everyone in there. So this is the framework for calculating tax liability. It's important that you understand it because this is the basis of your module. This is the framework which I designed for calculating tax liability of a company. First of all, amounts must fall into gross income. In the coming chapters, in the coming days, we'll be able to explain them fully. There's a definition which amounts, which is used to determine amounts that must qualify. We have got special inclusions. After determining amounts that fall into gross income, we have got income which is exempted. Remember I said taxation is a tool used by government. So as they collect the revenue, the government will also try to promote some sectors, to encourage some sectors, to discourage some sectors. So we've got exempted income. This is income which the government says, yes, this amount qualifies into gross income, but is not subjected to tax. So after you have determined amounts to fall into gross income, you should now learn which amounts you have included here but are not subjected to tax. You can then subtract them. For example, local dividends. Investment it's encouraged in the government, by the government. Then they would say, okay, if you have got shares in the company and you earned some dividends, they will be fully exempt. They will not be subjected to tax. But dividends are part of gross income. You can now subtract all amounts which fall under gross income, but they are exempted. So here is how you subtract amounts. First, those ones which are exempted. So after you have subtracted exempted income, your answer would be your income. As you go on, if you are asked what is income, you would simply say a gross income minus exempted income. Then you have got income. From that income, you have got allowable deductions. That's where you look at what must be subtracted. A lot in this module is based on these three things which must be subtracted. One, there is the general deductions. That is, a general deduction is applied on any expense which does not fall under specific deductions, and the capital allowances on the use of assets. Then you apply the general deduction formula under section 11A. So after you have subtracted anything which must be subtracted, you can now add taxable capital gain from the disposal of assets. Yes, to get a subtotal, if the taxpayer made any donation to public benefit organization, the taxpayer would be entitled to a deduction. A deduction would be limited to 10% of the taxable income. Later on, you would get your taxable income. After getting your taxable income, in this module, you are going to, the companies you will be dealing with, it's either micro businesses. In the coming exercises, you will learn more about micro businesses. And you are also going to be tested on small business corporations or companies which are not either of the two. With micro businesses or small business corporations, you use tax tables. Let me go to the fundamental, to those binding general rulings. So if the taxpayer is a micro business, you use the turnover tables based on your taxable income. If a company is a small business corporation, these are the small business corporation tables you use. But if it is a bigger company, which is neither of the two, there's a fixed rate of 27%. Now, I said this is an old textbook, but now the rate is at 27%. So yes. So after you have determined, then that's when after you've determined your normal tax, there's a prepaid tax, which is called the provisional tax. A provisional tax, that is the tax paid in advance. It's another exercise which we'll do in the coming weeks on how to determine provisional tax. You must remain part of the class so that you get to understand these things. You subtract your provisional tax, you have got a tax liability or refund. So this is the framework for determining a tax liability of a company. So back to the question. Which of the following best depicts the taxable income calculation framework? Deductions and allowances less income plus taxable income. Is it true? No, you don't start with the deductions, isn't it? If you start here, you don't say deductions, then you get income. You must get income first. Then you subtract allowable deductions, and then you add taxable income for you to be able to get your taxable income. So option 1 is wrong. Option 2, income, yes, less deductions and allowances plus taxable income plus taxable capital gain. Yeah, this one is right. This one is close. But let's see others. Then here it says income less taxable capital gain. No, you don't subtract taxable capital gain, but you add taxable capital gain. Deductions and allowances less taxable capital gain. This one is completely wrong. The answer here, we don't want it to answer is option 2. This one best depicts, yes, income. Yes, you said you start with the gross income, you subtract exempted income, then you get income. After getting your income, you now subtract deductions and allowances. After that, you would now add taxable capital gain. So option 2 is the answer. Anyone with a question? Anyone with a question? Anyone who doesn't find anything here? Feel free. Let's interact. Question 7. What does the following statement mean when we say the burden of proof vests with the taxpayer? If we say the burden of proof vests with the taxpayer, I'm sure it's more like self-explanatory. Like the burden of proof is on you, the taxpayer. So this is, you apply this when you are in a dispute. When you are disputing SARS assessment, remember I said you filed in your return. You file in your return, and SARS determines your tax liability, but you are not happy. If you are not happy as you object, because you are the one objecting, the burden of proof normally vests on the taxpayer, but at this level. But when you are deeper into tax administration, that is TAX2704, you would realize that there are some situations where the burden of proof would be on SARS. I will briefly educate you that. But for now, unless here and there the burden of proof, if you are objecting, you must gather all the records, because when you are objecting, You know yourself better than SARS. You have got all the records. The burden of proof is on you, the taxpayer. You must prove to SARS that their assessment is incorrect. Here we go. You must prove that this assessment by SARS is incorrect, which is option 2. It is your responsibility when you are objecting. You have to prove that the assessment by SARS is incorrect. The burden of proof would be on SARS, especially Section 95 of the Tax Administration Act says if a taxpayer fails to submit a return, then SARS is allowed to make an estimated assessment. So now, if SARS make an estimated assessment and you are objecting to that estimated assessment by SARS, the burden of proof would be on SARS to prove to SARS or to the taxpayer court on how they came up with such an estimated assessment, or on penalties. Remember, with the penalties under Chapter 16 of the Tax Administration Act, the penalties are more dependent on the behavior of an understatement, which ranges from substantial, greater care not taken, gross negligence. Remember, those behaviors are more like objective in nature. It's not like straightforward. When SARS says gross negligence, you say no, there's no negligence. So the burden of proof would be on SARS to prove that this is gross negligence, because the person of your capability and capacity, you should know this. But for now, at your level, the burden of proof is on the taxpayer. They have to prove that the assessment by SARS is incorrect. Which option? Which option? Which option here? Option 2. Option 2, sorry. Are we going somewhere? Or I'm speaking Greek?
Yes.
Yes.
Okay,
Yes.
if you're happy with where we are going, it's fine. I invite other students in class. Next week must be my last class I'll give you for free. You would have to join. The fee is not very exorbitant. It's very affordable. And this module, don't take a mistake of thinking like it's going to be a walk in the park. You need some help. What does the okay? Are you speaking Zulu?
Sorry about that.
Okay, I thought maybe you're asking a question.
No.
Okay, let's look at a question. What does the understatement penalty relate to? Remember, I talked about it a little bit here, about burden of proof, where I say only under a situation where there's an understatement penalty being imposed, by SARS on the taxpayer. That's where the burden of proof will be on SARS to prove why they say such is a penalty. Let me see if I can go to the understatement penalties quickly. If I will be able to go to there quickly, yes. Yeah, this is tax administration. Yeah, burden of proof, which we're talking about, is here. Yeah, administrative penalties. Here we go. Yeah, we can stay here on understatement penalties. So in understatement penalty, it's a penalty which is imposed by SARS if the taxpayer make an understatement on their return. An understatement is a situation where a taxpayer has made an omission on his return, or you sold an asset and you don't include an amount from the asset, or you get some form of an amount somewhere and you don't disclose it, you omitted it in your return. That is an understatement. Or you exaggerate your expenses, or you included some expenses which are generally not allowed as a deduction. As a result, you would be influencing SARS to impose a tax on you which is less than what you were supposed to pay. I'm sure you understand what I'm trying to say, isn't it? So an omission on a return, a default, you defaulted on your return, or if there is no return which is allowed, you pay less tax than what you were supposed to pay. That is an understatement. So if you make such an understatement, SARS is going to charge you an understatement penalty. So that penalty is based on this behavior. This is the table. If it is substantial penalty, on a standard case, it's simply 10%. But if it is obstructive, it means a repeat. Like in the previous, not more than 5 years, you have repeated the same mistake, which is substantial. Then the penalty would be 20% if you are repeating. But for the first time, for the first instance, it's 10%. The second behavior, it's reasonable care. You did not take reasonable care when you were completing a return. Like you should have known it better. But however, we can't say it's gross negligence. But you did not take reasonable care. As a result, you omitted some amounts. Then on a standard case, it's 25%. But if you are repeating, it becomes 50%. No reasonable grounds for tax position taken. You can't really explain yourself. There are no reasonable grounds on how you have omitted it. If it is a standard case, like the first time, it's 50%. But if you are repeating, the penalty would be 75% on the shortfall. I remember, understatement is when you are now paying less tax than what you were supposed to pay. There's a shortfall. Then there's impermissible avoidance arrangement. Remember, there is a permissible when you avoid. An avoidance which is allowed is you take advantage of the law. You take advantage of the law. You use the law to avoid paying tax. Remember, I said the law, there are some sectors which are promoted, there are some sectors which are restricted, but you play around what SARS would allow. But now, when it is impermissible, you crossed the line a little bit. In an effort to reduce the law, you don't actually apply the law properly because you wanted to apply the law, but you did not understand the law. It becomes an impermissible avoidance. It's closer to intentional. But here you were playing around the law, but the thing is you did not really understood the law. It becomes an impermissible arrangement. If it is standard case, it's 75%. If it is a repeat, it's 100%. Then from there, another behavior, it's gross negligence. Under gross negligence, here you are reckless. You should know better. Sometimes you are learning to be accountants. You are an accountant. We can't say it's intentional, but you should know that you must have these records. You must know that this transaction is where you were negligent, because as an accountant, you know where you get your information. You were simply negligent. You did not keep your records properly. If you have followed the rule, the accounting rule, you should have picked this up. Because you did not follow the required accounting principles, you missed this amount which you should have included. That is gross negligence. Then it's 100% on a standard case, but 125% if you are doing it for the second time. Then lastly, it's intentional tax evasion. Those who follow the news, I'm sure you know Yoster, who is that strain of guy. you just like, for the purpose that I wanted to avoid, I'm evading tax. This is more like a tax evasion. I wanted to go against the law. The difference between impermissible and this one, you wanted to follow the law, but you did not understand it properly. But here, you know the law very well, but you simply go against the law which you understand. It's 150% on a standard case. But if you are repeating it, there's gross non-compliance here. It becomes 200%. However, there's a window for voluntary disclosure. Voluntary disclosure is now if there's any understatement which you have made and you quickly picked it up, but before any notification from SARS that SARS are suspecting something, you are allowed to go and disclose. If you disclose to SARS what you might have done, from substantial to impermissible avoidance, there's no tax, there's no penalty which is going to be imposed. It becomes 5% on gross negligence and 10% on intentional. Then you say, no, here is the thing, it was more intentional, but I'm disclosing it now. Under column 5, you can disclose after notification. Disclosure after notification, it's in a situation where a SARS or a SARS official ask you to help them, especially if SARS realize that they will unnecessarily use the government's resources to carry out an audit. So if it is necessary to save the resources, or if SARS realizes that no matter how they dig, they need your cooperation to uncover this, then they can allow disclosure after notification. As you can see, the penalty is very low, especially on a substantial 5% instead of 20%. Under reasonable case, it becomes 15%. Under no reasonable grounds, 25%. It's a little bit lower. So that is it on understatement. I've given all on understatement. Let's go to the question and hear what the question says. Payment of incorrect amount to SARS. Shortfall paid in respect of a penalty. Payment, omission or incorrect statement in the return. Default in rendering a return. I'm sure what is an understatement is a default in a rendering a return, yes. Omission or incorrect statement in the return, yes, it's an understatement penalty. Shortfall paid in respect of a penalty. It doesn't relate to a penalty. But payment of incorrect amount to SARS, yes. This one, if you don't have to return, if you are not required to submit a return, if you pay an incorrect amount to SARS, it's understatement. The question is, say, what understatement penalty does not relate to? Yes, then it's option 2. It's option 2. A penalty here, we cannot say in an understatement. A penalty is where SARS tell you exactly this is your penalty. But if you pay less, it means maybe you don't have enough money for that. It can't be regarded as a nanny, as an understatement. Maybe you can arrange an installment payment agreement. You can communicate, I don't have all money, but I'll pay you maybe next month. I'll pay the balance next month. You make a payment arrangement. Understatement. A, default in rendering a return. B, omission or incorrect statement. In the return. So in your return, you put an incorrect information to deceive a SARS official. That will be regarded as an understatement. C, paying an incorrect amount to SARS. Payment of incorrect amount to SARS. So this is it, because not in all situations you are not required to submit a return. So meaning what you would simply do here is to go and pay. If you pay SARS less amount than what you were supposed to pay, then it becomes an understatement. Then option, what is the correct answer? It's option 2. Shortfall in respect of a penalty. Does not relate to understatement. Question 8. Question 9, sorry. Are we getting somewhere? Are we going somewhere? Am I going somewhere with you guys, or I'm moving on I'm moving alone?
Yes, we're getting somewhere.
Neo has a refund of 600 Rand. outstanding for 5 months from SARS for the 2021 year of assessment. SARS credited your account with a 6% interest, and she now has a total refund of 606 owed to her by SARS. She wants to know if the interest credit is an error. Is it an error? Generally, it's not an error. So if there's an amount owing, like you paid more tax than what is required, and the SARS, you're entitled to a refund. So if SARS does not refund you in a specified period, that amount would start accumulating interest. And on the other side again, if you owe SARS money, and by that time you are going to pay by the time, because on the notice of assessment, there's a date which is stated when you must pay that tax liability. If you don't pay tax on that particular date stated on the notice of assessment, that date would start accumulating interest. You'll be owing SARS. So let's read the interest credit is an error as SARS does not pay interest on outstanding refunds. No. The interest credit is not an error as SARS pays interest on outstanding refunds. So NEO is entitled to the interest, yes. SARS will reverse the interest credit only pay NEO the 600 Rand. No. SARS only charges interest on outstanding accounts and does not pay interest on outstanding refunds. No, they also pay. Let me go to the textbook. I'm sure I saw refunds somewhere. It said that SARS may audit a refund, but the refund can be made notwithstanding the audit. If the taxpayer gives security for the tax, the refund is to be claimed within 3 years. SARS may also set off refunds off against other taxes owing. So the textbook does not give much. Because of time constraints, I'm not going to go to the Tax Administration Act. Because once again, this is the phase which is passed soon. The examination doesn't test you much. It's more like they are only giving you general knowledge about tax administration here. So here, yes, this is the answer as per my explanation. There's no error. Let me just do this. Option 2. Let's go to question number 10. Which one of the following statements does not apply to the understatement penalty calculation? Here we go, the understatement penalty here. The understatement penalty percentage are not the same for each offense. This one is true, isn't it? I'm sure you saw it, are not the same. It will depend on the behavior. The penalties are not the same on each crime. If more than one behavior applies, SARS will add the understatement penalty table percentages together. What does this say? Here it says, let's say SARS saw some elements of reasonable care not taken, no grounds taken, impermissible avoidance and all, are they going to add 25 plus 50 plus 75 plus 100 plus 150? Are they going to do so? No, they don't. What SARS would do, they take the highest penalty and apply it. If SARS identify all the behaviors, then they can only take 200%, which is intentional tax evasion. Are we together on this one? So,
Yes.
option 2 is not. The understatement penalty percentage is applied only to the shortfall of the tax, yes. So if there's a shortfall, yes, it's applied. For example, you paid less tax than what you were supposed to pay. Yes, that difference, that is the shortfall. That percentage is applied to that shortfall. Or maybe you get an assessed loss when you were supposed to get an assessed loss. It's a shortfall. Or SARS end up refunding you when you were not supposed to be refunded. You have made a shortfall. The maximum tax rate applicable to the taxpayer is used. So which one it does not apply? A, yes, the maximum rate is applicable, is used, yes. If there is different behaviors, the maximum rate is used. The understatement penalty percentage are not the same for each, yes, it's not the same. If more than one behavior applies, option 2 is wrong. They don't add all the percentages, but they only take the highest percentage. They only take the highest percentage. Understatement penalty. Let's do question 11 and then we'll end here today. And then next week, my final class, which will be free, we answer the rest of the questions. So we'll see how far we'll go. Which one of the following statements is true for a part? Question 11. Which one of the following statements is true for the requirements of the Tax Administration Act with regards to the conduct of tax practitioners? So who is a tax practitioner? Who is a tax practitioner? So a tax practitioner is any person who submits a return to SARS or who gives tax advice, but not for free, but for some consideration. You are paid to do so, not under employment. I'm sure it's section around 240. It's section 240. Let me go to. It's section 240 of the Tax Administration Act. Yes. Section 240, you are required to register. But roughly, somebody you register with the controlling bodies that offer regular training, controlling bodies which will punish you if you cross the line. So you must register. But generally, a tax practitioner is somebody who give advice or submits a return for payment, for consideration, not when you are employed, no. If you are employed under a tax practitioner, you are not a tax practitioner. Let's quickly look at the solutions. Not all tax practitioners are required to be registered as tax practitioner. No. All tax practitioners must be registered. All persons have 21 business days to register as tax practitioner from when they first provide the tax advice. Yes, from the time you give tax advice, 21 business days you must register. The Tax Administration Act does not deal with the recognition of controlling bodies. No, it deals. You must give the recognized bodies are your SICA and so forth. Not all tax practitioners are required to be registered with a recognized body. They are all required. They are required. So the answer would be option 2. If you start providing advice, or you are helping somebody to submit a return for pay, not like somebody, not just your friend you are helping. If you are helping your friend, you don't have to register. But once you start getting money for your services, you have to register within 25 business days of doing so. That is the end of the class. Option 2 is the answer. Yeah. Before we end our class, anyone with the questions? Anyone with the questions? Anyone with the requests? Anyone with the requests? Anyone with a question? I'm sure you are all happy. If you are happy, my name is Madondo. Mr. Madondo is very happy. Thanks so much for your time. Thanks for your time. Invite your friends for our last free class. It might be helpful. It's going to be helpful. I will share the recording and share it with your friends so that they can hear. They can also listen to it. Thanks so much and have a nice weekend. See you again next Saturday, exactly at 6 p.m. Cheers.